So traditional uses of RSI. So you guys may well be familiar with these. I'm sure plenty of you are just doing a bit of a refresher. For those of you who are new, these conditions, these uses sound a bit weird, but they're actually quite simple, and I'm going to demonstrate them in just a minute. So the traditional uses, overbought and oversold, as well as divergence, and then some alternative uses of the RSI, identifying bullish and bearish ranges, and positive and negative reversals. Now, it just so happens that I did a separate YouTube video just yesterday on the upcoming Facebook and Microsoft results, and it's Facebook, I believe, that has a positive reversal in the RSI. So we can see if that pulls off. That's something to check out on YouTube afterwards. Before we get to that stage, this is the overbought and oversold idea. So basically, the idea is that when the market gets over the 70 level, so obviously, as we said, down here, this is the RSI, starts down here at 0, ends up here at 100. Over the 70 level, it's overbought. So between that 70 and 100, it's overbought. Between 0 and 30, it's oversold. So when the market dips down through this 30 level, it's oversold. So idea being that it's just the market suffered a bout of selling, the market's dropped a lot, and it's due a bit of a bounce back. So as you can kind of see from this chart, here we get the price breaks through the 70 level, and it keeps running higher, has a little dip, and then actually runs up and does a little pattern in the price, a little kind of double top pattern here. But you'll notice actually that it dips back through the 70 level, and that's when we start getting more of a sign that actually the market is topping out. So the general rule of thumb when you are using these levels in some way in your trading strategy is that don't immediately sell the market just because it's popped into overbought territory. Don't immediately buy the market just because it's popped into, because it may dip right down to 0 if things get really extreme, and equally 100 on the top side. So what you really want to see is the market pull out of that overbought or oversold condition before you then start looking for the opportunities. So sometimes it works better than others. We had a big run down here from the oversold condition, overbought, but then this oversold condition, we had a kind of little minor bounce back. They kind of grinded higher a bit. But then, as you can see here, nothing's perfect. The market was pretty soft basically at this stage, and I'll talk more about this in a minute. It never reached up to the overbought condition because the market was in kind of selling mode at this point, and it just hovered around the midterm and then dropped again. So there was no RSI signal or based on an overbought level to take advantage of this particular trade. Again, you can't take every opportunity necessarily. So for this particular technique, the market got really oversold again at this point, and then actually this provided a pretty nice entry point with the benefit of hindsight. By the time you get this signal of the RSI being out of the overbought zone, you probably already missed these first 2 candlesticks. But again, you can't perfectly pick the bottom. The idea here is to kind of catch some kind of durable move in the market. So then eventually the market does grind high with not too much in the way of retracement, and actually, as you can see, pretty much comes up to the resistance here that we saw at the start of the chart. And then again, once you hit that, you have that both the price as resistance as well as the RSI coming out of its overbought zone, gives you a bit of a little trigger to sell the market lower. So, word of caution here, if there is a strong uptrend, you can, and certainly people do it, but I don't advise selling within an uptrend. It's just you're going against the flow of the market, and obviously where the interpretation in this particular scenario that we're looking at is, ideally you don't want to be selling the overbought conditions in an uptrend, because it's going to remain overbought for a while because people are buying it. It's an uptrend. So as you can see, the market will roll over from the overbought level, but it won't be durable. It won't even get down to the previous low, obviously. So it's difficult to find a price target. And when it does rip the other way, you tend to get these big, like, bullish engulfing patterns, and it will take you right back up to your entry point. So you can kind of go for it. A lot of the time, you'll get a scratch, you know, basically a break-even trade, or a few small wins. But, you know, it could just blow completely in the direction of the trend again and, you know, catch you out. And to be honest, to me, in terms of risk reward, it's just not worth it. So switching gears to divergence. So divergence is, you know, there's kind of convergence and divergence, if you like. Divergence is typically the one that will give you more of a signal, and it's how the RSI down the bottom here relates to the price in the top of the chart. So the idea being that you're comparing the kind of swing lows in the RSI to the swing lows in the price. So if price is making a lower low, as you would expect it to do in a downtrend, maybe the downtrend started up here, we're trending lower, but then suddenly the price makes a lower low, but here you see the RSI making lower lows, but then suddenly the RSI makes a higher high, and then breaks above its old swing high like so, matched with perhaps a bullish looking candlestick pattern. Then you can see that actually the momentum is shifted in the market. The momentum turned first, represented by the RSI, and price duly followed suit. So another example here, and you can see it doesn't work perfectly every time. So here was the first example, which obviously I've drawn the nice example that worked. So here, price made a lower low, or a lower low there. RSI made a higher high, higher here. But even though you got a little pop in the market, it did roll over again. You know, I'm glad to be showing you this because not every, not every strategy works perfectly, right? You know, the best strategies in the world have probably a 65% success rate. In my experience, with those with a good risk to reward. Obviously, if you're trying to hit 1 pip and you're risking 100 pips, then you're going to have a pretty good win ratio. But it's not a particularly durable trading strategy in my mind. If you're looking at kind of trading strategies where your wins are going to be more than double your losses, in terms of the size of the win, you know, you're winning 100 pips, losing at 50 pips, that kind of thing, you're not going to get much more than a 60% success ratio. That's because of little scenarios like this. The general technique works, but the market has a mind of its own. It will do. You know, these techniques won't work every time. You know, that's why we use stop losses. But I hope you've got the general idea there in terms of divergence. Now, this is where I've pulled back that, you know, when we were talking about the overbought and oversold scenario in the other chart, and we're talking about this is the uptrend. We don't really want to be necessarily taking these oversold signals, but we do want to be buying all these dips. So how do we do that? Well, we add a new line into the RSI. We were looking at 30, we were looking at 70, but when we see the price trending higher, breaking above, making a higher high, making a higher low, breaking above, making a higher high, higher low, it's in an uptrend, right? That's how we designate an uptrend, moving from the left bottom left to the top right. We can shift the level that we're focusing on down from this overbought 30 level up to the 50 line. And you'll find that the 50 level works rather well under certain trading environments. Sometimes it will shift up to a 60 in a very aggressive trend. But 50 is a good kind of general level to say that when you see a kind of some sort of trigger, perhaps a bullish engulfing pattern, candlestick pattern, or a short-term trend line break, or I'm going to have a different webinar actually, as it happens, on different triggers, entry triggers to trades. But if your entry trigger to the top side in an uptrend happens and RSI has just pulled back to around the 50 level, that's often a good value place to be buying in an uptrend. So it's these red arrows here that we're focusing on, the dips to the 50, 55, 60 level in the RSI, rather than the hardcore oversold condition, which just isn't going to happen in an uptrend, right? Because again, It's going to be more buying than selling. You're going to be more overbought than oversold. You're not ever going to get really oversold. But it is worth noting that the trend continues here. If I extended this trend line, you'd have a bit of a trend line break. Then we actually take out that support here, and a little pre-warning. Trend line was probably the first signal. Second warning was that we drop through the 50 level. And then probably third warning, when we drip down to this 30 level, is actually we've kind of shifted out of that uptrend environment. We've now drifted into a sideways environment where you can see that over here the price got capped by that old high. So the trend may resume to the top side again, but we've just shifted into more of a sideways trading environment. And so you can see that through the movement to through support, which typically you wouldn't expect to happen in an uptrend. But also RSI adds a bit of evidence to that idea by moving down to 30 and not holding above the 50 level. Okay, we just had a question from Ed talking about down here in the indicator. It has close and 14. 14 is the periods that you're setting the indicator to. So you can do it in the LCG trader, which I base these charts on. Other platforms too. You can generally customize your indicators. So 14 periods is what Alexander Elder, the developer of this indicator, thought worked best. And in my experience, in terms of using these bullish and bearish ranges, I agree with him, and I stick with the default of 14. If you want more kind of, basically, if you turn it down to 10 or 5, for example, you'll see much more erratic moves. The indicator will become a lot more sensitive. If you cranked it up to 20 or 50 even, the indicator would become a lot more smoothed out. You'd get a lot less signals, but theoretically the signals you'd get would be more categoric, perhaps stronger. But obviously longer time frame in nature, using 50 periods of data instead of 14. Then close, I'm not 100%, but I assume that's it's basically using closing prices rather than intraday prices, which tend to be less reliable. So it can be the close of the 1 hour period, or it could be the close of the day. I hope that makes sense.